Good morning. It's Friday, the 13th of December, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. Well, it is Friday the 13th, a date considered unlucky by some, mostly I think because there's a Hollywood-made horror movie by that name. Meanwhile, we are almost halfway through the last month of 2024, and I think this is a good time to tell you that we will be taking a news break in the last 10 days of 2024. We will take a news break and not a break, and we will be presenting a wide range of interviews and conversations around what the world of business and economy will hold for us in 2025. And now back to 2024 and the top stories and themes. The markets slip again and they wait for a bottom-up Santa rally. Inflation drops from a 14-month high to 5.4%. The Organization of Petroleum Exporting Countries has once again cut oil demand forecasts for next year. Gold and silver futures rise on speculation that the United States may put tariffs on their imports too, that is, imports of gold and silver. And finally, is India's bank credit growth hitting a wall?
This is the Core Report with Govindraj Ethiraj.
The markets wait for a Santa rally. So the markets are right now taking some deep breaths, but otherwise seem to be standing by, waiting for cues, I guess. On Thursday, the Sensex and the Nifty were down, with the 30-share Sensex falling 236 points to close at 81,289 after swinging a fair bit during the day, the kind of swings that we've been seeing in recent days as sellers and buyers face off. The Nifty closed down at 24,548 and it was down 93 points from its previous close too. The broader markets were down as well, with the Nifty Midcap100 and the Nifty Smallcap100 both down by between half and close to 1% respectively. So the markets, like we said, are anticipating a Santa rally, which is going to be mostly bottom up rather than top down from what it appears right now. One reason that Santa rally could materialize and before Christmas is, of course, Wall Street, which continues to rally strongly. On Wednesday, investors poured into technology giants and sent stocks higher, snapping a two-day slide thanks to a benign inflation report that strengthened expectations that the Federal Reserve will keep cutting interest rates. The Nasdaq 100 climbed close to 2% to a record. The S&P 500 rose close to 0.8%, again close to a peak. Broadcom led that advance following a report that the chip maker was working on an AI deal with Apple Inc. Bloomberg reported all of this and added that the so-called Magnificent Seven were once again in the pole position, with shares of Tesla, Amazon, and Meta platforms hitting all-time highs. The rupee is flailing. The rupee fell to an all-time low on Thursday, pushed down by expectations of a depreciation bias and strong demand for the US dollar in the non-deliverable forwards market, or NDF as it's called, according to Reuters. So the rupee hit a low of 84 rupees 88 paise against the dollar before closing at 84 rupees 85 paise, down slightly on the day. The dollar index, another index we all track, was unchanged at 106.5. So the Reserve Bank has been routinely selling dollars in the spot market, like on Thursday, to support the local currency as it has hit consistently new all-time lows. Bearish bets on the rupee have climbed to a 2-year high, according to a Reuters poll. OPEC cuts growth forecasts. The Organization of Petroleum Exporting Countries, or OPEC Plus, has cut oil demand forecasts for this year and next for the 5th straight month, marking its deepest reduction to the 2024 outlook so far after agreeing to extend its supply curbs, according to Bloomberg. Now, the overall commentary that follows, and I will get into some detail, is important not because it is just oil prices we're talking of, because it represents where the global economy is perceived to be going and, of course, the sharp differences in those perceptions and expectations. So, the OPEC has cut projections for consumption growth in 2024 by 210,000 barrels a day to 1.6 million barrels a day, according to its monthly report. And the cartel, has slashed projections by 27% now since July. Last week, the OPEC Plus alliance led by Saudi Arabia and Russia agreed for a third time to delay plans to restart halted crude production while also slowing the pace of increases once they do begin next year, according to Bloomberg. Now, the first in a scheduled series of hikes was postponed to April from January. Remember that oil prices have fallen almost 17% since that July period as demand from China has slipped even as supply, including from the Americas, has boomed and increased. Now, Brent futures were trading around $73 a barrel right now, and that figure is considered low for the Saudis and others in the coalition, that's OPEC, to cover their government spending. So remember that a higher oil price is in their interest, as it is not for countries like us who import most of our oil requirements. Now, OPEC's Vienna-based secretariat said that the revision takes into account recently received bearish data for the third quarter, including downward revisions to OECD Americas and OECD Asia Pacific. Now, the interesting thing is, despite all the downgrades around, OPEC's forecasts apparently are significantly higher than most others in the oil industry and at odds with actual data for consumption this year. Bloomberg says the alliance's growth projections for 2024 are roughly double those of Morgan Stanley and Goldman Sachs and considerably above the International Energy Agency in Paris. It's usually interesting to see how the International Energy Agency and the OPEC have varying figures and estimates on demand. However, the OPEC figures are even higher than estimates from Saudi Arabia's own state oil company, that's Aramco. So, OPEC says oil consumption will average about 104 million barrels a day this year, and it lowered growth estimates for 25 by 90,000 barrels a day to 1.4 million barrels a day. Could there be tariffs on gold and silver in the US? Could 10% tariffs that incoming US President Donald Trump has promised hit gold and silver as well? Well, that's what the markets are fearing, going by reactions. Premiums for gold and silver futures in New York were up as traders weighed the possibility of precious metals being included in sweeping tariff measures proposed by incoming President Donald Trump, according to Bloomberg. Gold futures for delivery in February traded as much as $60 an ounce, or roughly 2% over spot prices in early London trading, while silver futures were more than $1 an ounce, or 3% higher. According to a strategist at the World Gold Council, if some market participants believe that there is a non-zero probability of tariffs affecting gold, silver, and copper imports, then it makes sense to cover any short positions. He also said that it might cost a little money to do so, but the potential cost of not doing so is enormous, and that traders could lose nearly $300 per ounce of gold if 10% tariffs were enacted, far in excess of the potential profits to be made if these precious metals are exempted. Apparently, the last time something like this happened was at the beginning of the COVID pandemic, when traders were fearful about getting gold to New York in time to settle futures contract, according to that same Bloomberg report. Apparently, in those chaotic couple of days, the premium for New York futures over the London spot rose above $70, which in turn was the highest in 40 years. Now, this time around, there are no issues with transporting physical bullion between New York and London, which is usually done via aircraft. And yes, indeed, that does happen. Inflation is down somewhat. India's consumer price index-based retail inflation was down to 5.48% in November from a 14-month high of 6.2% in October. This is basis data released by the Ministry of Statistics and Program Implementation, or MOSPI, on Thursday. The data shows higher inflation in rural areas at about 5.9% compared to 4.8% in urban regions. Food inflation is still high, though lower at 9% for November compared to 10.8% in October, thanks in turn to high prices of vegetables, fruits, oil, and fats. And within that, remember, potatoes, onions, and tomatoes. Rural areas experienced a CFPI inflation, that's food price inflation, of 9.1%, and urban regions saw a slightly lower rate of 8.7%. Rising food prices in general have obviously reduced the purchasing power of lower-income households, particularly affecting festival season's sales this year, according to a Business Standard report. India's industrial output, these figures also are put out at the same time, rose to 3.5% in October from 3.1% in September, thanks to a rebound in the manufacturing and electricity sectors. The ECB cuts rates. Expectations are running high for a rate cut in India, even ahead of the next monetary policy meet in February, now that there is a new Reserve Bank governor who took charge earlier this week. But the Western world, meanwhile, is continuing to cut rates. The European Central Bank lowered interest rates for the third consecutive meeting, signaling more reductions next year as inflation nears 2% and the economy struggles. The deposit rate was cut by a quarter point to 3%, as predicted by all but one analyst in a Bloomberg survey, which brings the total cuts since June to 100 basis points. The ECB said on Thursday that the Governing Council is determined to ensure that inflation stabilizes sustainably at its 2% medium-term target and that it will follow a data-dependent and meeting-by-meeting approach to determine its appropriate monetary policy stance. Some interesting oil news, just to come back to oil. Russia's state oil firm Rosneft has agreed to supply nearly 500,000 barrels per day of crude to Indian private refiner Reliance, the biggest ever energy deal between the two countries, according to sources who spoke to Reuters. The 10-year agreement amounts to about 0.5% of global supply and is worth roughly $13 billion a year at today's prices, and would obviously cement energy relations between India and Russia. Reliance said that it works with several international suppliers, including from Russia, and deals are based on market conditions. They did not comment any further, nor did Rosneft reply to requests for comment, says Reuters. Is credit slowing down? A report by banking analyst Hemindra Hazari has argued that bank credit growth is hitting a wall. Hazari says that the critical drivers of growth of non-food credit in the recent period have been retail and to a lesser extent services, and not so much companies and businesses. On the other hand, as we know, the Reserve Bank has been steadily ratcheting up the pressure on banks and non-bank finance companies on lending, particularly retail and unsecured. So the retail driver has increasingly come under pressure as the Reserve Bank has been cautioning non-bank finance companies, microfinance institutions, and housing finance companies against aggressive lending. On the other hand, companies or businesses are not borrowing as much or as aggressively as they used to. Hazari says that Reserve Bank of India data on the sources of funds of companies reveals that in the first half of the current financial year, companies reduced their long-term borrowing while at the same time increasing their short-term borrowing as compared to the second half of last year and the first half of last year. So the deployment of funds by the company shows an increase in receivables and financial investments and no major increase in fixed assets. So he says that the companies are willing to deploy more funds in financial investments rather than fixed assets, and that indicates their view on future demand for their products. A CMI sample of about 3,300 companies as of December 8th also reveals a higher percentage growth in current assets as compared to fixed assets and income in non-financial companies in the second quarter of the current financial year. So the data therefore suggests that even the slight spurt in industrial credit may be deployed to finance higher receivables, which is not a healthy sign when there is a demand problem, he says. The questions, of course, are more to do with what's happening in the larger economy than just banking, and we'll come to that. So I reached out to Hemindra Hazari, and I began by asking him why he was concluding that a slowdown in bank credit was there, and secondly, what it meant and what was the outlook ahead.
Why is it worrying is that the retail credit only started picking up because the last 15 years, there has been a substantial decline in the share of industrial credit as compared to non-food credit. That share has been steadily declining, which tells you about the dire state of industry in the economy in the last 15 years. In banks, deposits continue to flow in, and therefore they need to deploy the funds in a profitable manner. Hence, they decided that they will push retail credit, and that has been the critical driver for overall bank credit in the last 10 years. And therefore, you have seen one is mortgages, which constitutes about 45 to 50% of retail credit, has been a driver. But mortgages and housing loans are not very profitable for banks because the margins are low on that product. And for banks, it can only be profitable if they have a lower cost of funds or they take higher risk and go into affordable housing, finance affordable housing. So the cream in retail really comes from, unsecured loans, credit cards, personal loans. That is where banks get and loan against property, which is more of a commercial type of product. So we have been seeing that these have been the drivers, as well as lending to non-bank financial institutions, which gets categorized as services. But non-bank finance companies, as well as microfinance companies and housing finance companies, their main source of funding is normally banks. And they in turn lend to the retail sector. So if you classify that also, these sectors have been the main drivers of bank credit in these years. Now, what has happened in the last 1 year is that RBI has been noticing that stress is building up, especially in the unsecured personal loans, microfinance loans. and therefore have been cautioning banks not to lend and increasing the risk weights. Now, typically when the risk weights are increased, it lowers the growth rate in those sectors for those loans. So now with the main driver being retail and non-housing, that has been slowing down significantly. The issue is what will drive bank credit in the future. And that is where the predicament comes in today for the banking sector.
On loans to businesses or companies, the general sense is also that companies are not borrowing because many of them, at least the better performing ones and the top 100, are cash rich. And they've used the last few years to deleverage to the point that maybe they're not really looking. And they may not be looking also because maybe they're not doing that much of investment in capital expenditure. This does not necessarily mean it's a bad thing, isn't it? At least from the company's point of view.
No, from the company's point of view, it all depends. Even if you see the corporate sales or revenue data, you'll find that the growth there is decelerating. If you look at the RBI survey on industrial capacity utilization, you would find it has, kind of stagnated at the 65 to 70% range. So there is essentially a problem of demand in the Indian economy. And earlier, it may not have been so visible in the formal industrial sector, which most of the stock market companies reside in, because the informal, unorganized sector has got totally squeezed out by demonetization and GST implementation. And their share had been captured by the formal corporate sector. Therefore, you did not see the impact of that impacting corporate sales. But since the overall pie was not growing, it was evident that this could only, go on for a certain amount of time. And now it has become visible, even in the formal corporate sector, that their sales growth is under pressure. So in such a situation, it is but obvious that there will be really no requirement for major external funds if capacity utilizations are going to be low and sales are also going to, growth rate in sales is also dropping. So hence, obviously, there will not be a requirement for external funds. And since the banking sector is the main driver, the main contributor of funds, you're not seeing that bank credit to industry has not been very significant in the last decade or so.
Right. And if I were to come back to retail, assuming, let's say, some of this is because the Reserve Bank itself has, increased risk weightages, made it tougher to borrow or definitely more expensive to borrow because it was seeing a froth in the system. If that sort of evens out and let's say slightly more mature borrowers come into the market or stay present, wouldn't that be good for the system overall in time?
Yeah, but I think you have to see this in the overall stress of the economy. You're very clearly seeing that there is a demand problem. We're very clearly seeing that there is a huge unemployment problem where all the data gets disguised because it gets classified under being self-employed, which is really disguised unemployment. So that is what are the reasons which is contributing to poor demand in the Indian economy. And added to this, you are seeing, rising food inflation. You are seeing the wage rate in India has been stagnant or in real terms has been declining for rural laborers. So all these indicate that there is a huge demand issue in the Indian economy. So you may get certain pockets of the economy which will do well, and that has normally been, the more higher premium segments. But those have never in any economy driven overall demand or overall bank credit. So therefore, it tells you that even with the retail, why is RBI saying be cautious? Is because that they are seeing that there are many individuals who are over leveraged and there is stress building up. You're seeing that definitely in microfinance, where the NPAs seem to be rising and the provisioning being made by these players has sharply increased. So there is no doubt that there is stress in the retail segment, and one can only come out of this if the government implements measures which can stimulate the economy to higher growth. But we really don't see that. There are only two drivers which can really stimulate the Indian economy. One is global growth, which global growth does not seem to be happening in a major way, or two, government expenditure. And if you see the data and what the government has been saying, is that they have been, lowering the fiscal deficit as a percentage of GDP. So even when you are having a lower government expenditure to GDP in an overall environment of suppressed demand, it means the situation can only get worse and not better. So in such a situation, my view is that bank credit growth as well as the economic growth is going to take a hit.
Between, let's say, share of credit between retail and institutional and its growth, I mean, we are obviously seeing some growth. The question is how much and whether it's desired. How would you compare this with where we were before COVID? And are you also seeing, like some economists are saying, some normalization now in terms of overall growth?
One must also recognize that prior to COVID, we were in an economic slowdown, which was independent of COVID, that we were already in an economic slowdown pre-COVID. And that's why the overall non-food credit just before COVID, it was only a mere 8% year on year. So we have been in an economic slowdown, and that is very clearly what the industry data suggests, right from 2008 onwards, which is post-Lehman. There was some recovery because of, fiscal stimulus. But once that stimulus was withdrawn globally as well as in India, the industrial credit has been going nowhere. And industry also has not been growing much. They've only been taking over the share of the unorganized and informal sectors. And that is why banks started pushing retail credit. Mind you, retail credit can be very expensive for banks because there are huge overheads associated with retail credit. You require branches on the ground, you require people to contact them. And banks have only done this because industry and corporate credit was not picking up. So in this context, when you see that you have seen a very sharp downtrend in corporate industry credit as a share of total credit coming down, and it is retail credit which has really replaced it. Now, in this present scenario where the RBI is saying that, and plus stress is building up in retail, it is very unlikely that industry credit can compensate for the eventual decline in retail credit.
Hemindra, pleasure talking to you. Thank you so much for joining me. India has a new chess champion. Indian chess prodigy Gukesh D emerged as the youngest world champion in history, dethroning reigning champion Ding Liren after a critical blunder in a dramatic finale at the 2024 World Chess Championship. The game, which had apparently already stretched into the fifth hour, appeared set to enter tie breaks, but a costly mistake by Ding allowed Gukesh to seize victory and claim the crown, according to a report in Business Standard. Throughout the match, Ding apparently found himself consistently trailing on the clock, a situation that had become recurring in this series. And by the 23rd move, Ding had 23 minutes less on the clock than Gukesh. Gukesh, who had shown resilience throughout the championship, used this advantage to push Ding to the edge. He had prepared well, pulling off novelties in the opening phase that forced Ding to uncomfortable positions. The players had apparently duelled for 3 weeks, each move building towards a tense conclusion. And here's some quick feedback before we go. Girish Lodha says, very nice and cogent content, keep it up. Egg Yolk says, best way to start the day is to hear you. Thank you very much, Egg Yolk, since eggs and yolk are also part of my breakfast. Dilip Vangal says, awesome rap. And Arun Ramachandran says, part of my morning routine, great and relevant content. Thanks, Govind and the team at the core. Thank you all on behalf of the team at the core for your really kind and welcome remarks and comments. We obviously use this to improve our content, of course, and to feel encouraged. See you next week. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.